following video module is on private equity. This will serve as an introduction to private equity funds and investors. Private equity funds seek to leverage expertise of fund managers or general partners with capital of investors or limited partners. A general partner is a private equity manager. Those terms are often used interchangeably. And a limited partner is the investors that have formed a limited partnership with the general partner in the fund. Funds are usually organized as limited partnerships, and they last a fixed amount of time, typically 10 years, somewhere around that time, depending on the fund. After that time, then the funds are dissolved. Evergreen funds are actually funds that are set up that can last indefinitely. So the lifetime of the fund can be much longer than a fixed amount, like 10 years. Limited partners provide the bulk of the capital, but like to see that the general partner has skin in the game. This is where the 99 to 1 rule comes into play. This is a sort of a rule of thumb where the limited partners like to see that the general partner has contributed some money to the fund so that he has something to lose if the fund does not perform at the level expectations that he's claimed to be able to achieve. This is sometimes 99 to 1, where the limited partners provide 99% of the capital and 1% is the general partners. Even though it's a small amount, it serves as an incentive to the general partner. Beyond that, the compensation agreement is typically 2 and 20, 2% management fee and 20% performance. So the general partner does have an incentive to generate returns in the form of positive performance because he gets a 20% cut of that. Fundraising is the way by which private equity firms raise money for a fund from investors. So they'll reach out to multiple investors through usually providing a private placement memorandum that describes the fund and gives the relevant information. Beyond that, marketers distribute that PPM to investors, and then they meet with the investors with the goal of getting the investor to sign a partnership agreement. This is called closing. So the general partner, either through in-house marketers or third-party marketing firms, will seek to add more capital to the fund. They'll usually have a target for how much capital they want to raise. Hopefully they'll exceed that amount, but they usually put a cap on it, and then that would be the first round of fundraising, and they will eventually close that fund. So the fund can contribute. The fund may contribute to raise capital with new investors until the fund has its final closing. At that point, the fund is now closed to new investors, and it'll be just those limited partners. And limited partners for private equity can range from a high net worth individual, family office, pension fund, endowment fund, other institutional investors. And these are the investors that private equity funds will typically target. You have to be an accredited investor to invest in private equity. And this means you just meet certain regulatory requirements. Many funds seek to entice investors and generate returns with their proprietary deal flow, comprised of companies that they are considering investing in, or they may even have already signed an agreement to provide private capital to that company. So these are just the potential companies that general partners will use to entice limited partners because they can promise that there's a chance that you'll be able to invest in these companies, and if you think that'll generate really positive returns, that'll be an added incentive for limited partners to sign an agreement with you. And so the private equity fund will take the capital contributed by the limited partners, and from that, the private equity fund will invest in multiple companies. So the limited partners contribute the capital, general partner manages that capital, and will invest it in various companies. Here's just company A and company B. and that will create the portfolio of investments that general partner is investing in during that time. For this, the first stage for a fund is generally the investment period, when potential investments are discovered, vetted, capital is drawn from limited partnerships, investments are made in companies. This is, of course, after careful research and due diligence done by the analysts and management team to see whether it's a good investment, whether they think they can really generate a good amount of return for their limited partners and for the fund. If those requirements are met, and if they really think there is a good chance for this company to be more profitable or to succeed in some way, then they go ahead and they invest in that company. We'll have more on the actual investment process for a private equity fund in coming videos, but for now that'll serve as a sort of introduction overview. Throughout the fund's lifetime, the general partner will receive compensation, as I said, typically in the form of 2 and 20, 2% management fee for operating costs. It'll cover pretty much any of the annual costs that the general partner knows he's going to incur. But then the 20% fee is really where the private equity funds make their money. And this is the 20% performance fee that is taken from the performance of the fund over its lifetime. Companies will often seek more capital than one fund is willing or able to provide, and at various times will raise more private capital through rounds of financing. These rounds are also called series. So it is Series A, Series B, Series C financing rounds. We'll get into this fundraising aspect more in future videos. Once the investments are made from the general partner to Company A, Company B in this case, the focus turns to making the companies more successful and profitable. Sometimes this is done through major changes, like replacing the company's management or selling non-core assets. For example, if Company A is really distressed at this time, and the share price was sinking prior to if it's an acquisition or it's just purchasing a small stake in it, the company can be failing in some way, and the general partner will come in and either just through an activist stakeholding or just by taking the company private through a leveraged buyout, the private equity firm will seek to change the management or make some sort of changes that the current management wasn't willing to do or wasn't capable of doing. And so the general partner will contribute its expertise to help make that company more profitable. In other cases, there's just a company that is either underperforming or performing at a level that could be increased through private capital. Maybe a company wants to expand but doesn't have the capital necessary to do so. You see this a lot through venture capital financing, where they just need more capital for that company to get to the next level. The capital can also just be simply to allow the current management at the portfolio company to expand operations or continue at its current pace if it's already very profitable. Unlike many hedge funds, private equity firms often take a long approach and work to improve the company in order to generate returns at the exit, whether through a sale to another buyer, an IPO, which is an initial public offering where the company that was taken private will go back on the public market or go onto the public market for the first time if it hasn't been a public company already, and shares will be distributed to the public. Or a secondary sale to another private equity firm is becoming very popular as an exit strategy for private equity funds. They want to exit an investment, and this is often from pressure from the investors to get out of that investment so they can receive their returns on that investment. And this can go through a secondary sale to another private equity firm or a strategic buyer, maybe a competitor even through a merger and acquisition. The goal is to achieve a higher internal rate of return than the price paid for the investment. And this is basically an overview of private equity. I ran through it pretty quickly, but this should give you a better understanding of private equity, how private equity funds work, the relationship between the general partners and the limited partners, and how they make an investment in a company and how they exit that company. All right, thank you for watching.